Most people choose a real estate project because it feels right. Maybe the render looks good, the payment plan seems easy, or the agent says everyone is buying this one. But here is the truth. Investment managers do the exact opposite. We don't start from the property, we start from the big picture, the economy, the market, the data. And only then do we choose the project that truly makes sense. And today, that's exactly what I'm going to show you, how to do that, how to analyze real estate using the same top-down framework we use in the financial industry to select investments. If you want to use the same worksheet that I use to evaluate projects like this, comment top below and make sure to subscribe, because every week I bring strategies that help you invest with real discipline. For those of you who don't know me, my name is Daniel Gevaux and I'm an economist and investment manager with more than 20 years of experience. I started my career in Brazil managing fixed income portfolios for private clients and institutional investors. Later, I expanded to the United States, developing single-family homes and structuring real estate investment vehicles. And today, I'm based in Miami and Dubai, where I help global investors analyze and acquire real estate with the same discipline and frameworks we use in the financial markets. After 2 decades in this world, from bonds to buildings, I can tell you one thing with certainty. Most investors make emotional decisions, not analytical ones. They fall in love with the design, with the location, with the trends, and forget to ask the only question that really matters. Does this make financial sense? And that's where the top-down analysis come in. It's how professional managers filter opportunities, starting from the macro environment all the way to the individual asset. And once you master it, choosing the right project becomes clear, logical, and repeatable. Step number 1 is the macro view, analyzing the country and the city before you even think about the property. In finance, when we choose stock, we never start with the company, we start with the economy. We look at growth, inflation, interest rates, capital flow, because a great company in a weak economy still underperforms. It's exactly the same thing with real estate. Ask yourself, is this country growing economically or contracting? What's the population trend? What's the government stance on foreign investment and taxes? And most importantly, where is the capital moving? If you take Dubai, for example, you have a perfect case of a macro story supporting the asset class. You have population growth, constant infrastructure expansion, and a favorable tax system and geopolitical neutrality that attracts global capital. Over 220,000 new residents moved to Dubai in the past year, but housing supply didn't grow at the same pace. That's a textbook imbalance between demand and supply, which for an investor signals appreciation potential. Compared to other markets, for instance, Miami or Lisbon, both solid but with different cycles. Miami appreciation phase is maturing, while Dubai still sits in a consolidation phase backed by fundamentals. When the macro aligns, you are no longer speculating. You are surfing a trend that already moving in your favor. That's why professional investors spend time here first, because if the macro isn't right, nothing else matters. Once the macro makes sense, we zoom into the sector or sub-market level. In the financial world, after selecting the economy, we identify which industries are outperforming: tech, energy, healthcare, etc. In real estate, it's the same logic. You ask yourself, which segment is currently undervalued? Which one has the best balance between risk and reward? Right now, in Dubai, most of the people are chasing residential projects, and yes, in the last 2 years were incredible for appreciation, but it also means that easy profit have been captured. Meanwhile, commercial real estate, especially flexible office concepts and branded business spaces, is still undervalued and underbuilt. We are seeing a rising number of entrepreneurs, freelancers, and companies setting up here in Dubai. But the supply of high quality small commercial units is extremely limited. That's why when I applied the top-down model recently, the data pointed clearly towards commercial projects. It's not about preference, it's about timing and fundamentals. This phase also includes analyzing the neighborhood's dynamics. Which zones are consistently absorbing the demand? Where the infrastructure projects being developed? What type of tenants or buyers are driving that area? For instance, Business Bay in downtown remains strong, but emerging hubs like Dubai Hills Business Park, Dubai Science Park are showing early stage potential. Areas where commercial supply is still low, but demand is forming. Once you understand the submarket movement, you stop following trends and start anticipating them. Now we go one level deeper, the project level. This is where you take all the macro and submarket context and apply to evaluate individual opportunities. Here, details matter. You're not comparing Dubai projects anymore. You are comparing business model. And when I analyze a project, I go through a 5-point filter. Number one, developer credibility, track record, delivery speed, after-sales support. Number two, price per square foot, how it compares to both immediate competitors and area average. Number three, payment structure, whether it protects your liquidity and provides flexibility. Number four, projected ROI and cash flow, based on conservative rent assumptions, not brochure premises. And number five, liquidity. How fast can you sell if the market turns? Once you score projects objectively, the noise disappears. You will see that 80% of launches are average, 15% are decent, and maybe 5% are worth serious capital. One example that came out on top recently was HQ by Rove, a commercial project that checked all the boxes. While most investors were still buying residential launches at a high premium, HQ by Rove stood out because of the fundamentals. It's a branded under Rove Hotels and respected name with operational credibility. It targets a gap in the market, small managed commercial spaces in prime locations, and is structured for investors, not speculators, with realistic price and payment plan and aligned with development progress. When I ran the model, factoring rent potential, occupancy, and exit value, the numbers position HQ by Rove as a strong commercial proposition in Dubai right now. Not because it looks nice, but because it fits perfectly within the macro and sub-market story we just discussed. That's the top-down analysis delivered, clarity and conviction. If you want to use the same process, I've prepared a worksheet that walks you through the same framework, step by step. You just need to comment top below, and I will send you personally. I don't use automation. And make sure to subscribe, because next week I will bring other models that will help you analyze residential and commercial assets. And when one makes sense and the other one doesn't. Choosing a real estate project like an investment manager means flipping the process upside down. Instead of starting with the unit or the brochure, you start with the macro, where growth is happening. Then the sector, where the opportunity is forming. And only then the project, which is the vehicle that fits that strategy. It's a mindset shift from what's selling to what is sound. This approach just doesn't help you find good deals. It helps you avoid bad ones. Because when you make data-driven decisions, you are no longer chasing the market. You are leading it. So next time you see a flashy launch, don't rush. Pause, take a step back, and start from the top.